for joining this session. Thanks for joining this session today. This session will be based on individuals, and we'll specifically be tackling the tax payable on individuals. So I was kind enough to go through most of the sections for tax payable, and I'll use last year's assessment 4 to illustrate like the principles that are important for you like to perform successfully in the calculating the tax payable for individuals. Yes. So as you know, here at PRS, you always start with the approach. To know the perspective, who you are. In this case, it's easy. You're an individual. And you know, they will affect the type of legislation and or standards. Specifically in tax, it will affect the type of legislation that will apply to the individual. Then you know that since you have the perspective, guys, please mute your yeah. So since you know that you've got your perspective of an individual, you must know how to answer these things. So to answer successfully across across all modules actually here in accounting, you start with your trigger, you go to your scope, and you go to your implication. So you answer from left to right as always. So this transcript is about the calculation of tax payable. Then there's some additions. Then you have to understand like why we are doing this. Then like the what is in the transcript, I'll explain like the what's the content and everything regarding this, and the how. You see what I mean? How is the application of the framework? So for this topic, tax payable, the objective driver in this case, the objective driver in this case is simple as you just have to calculate the tax payable to SARS by the taxpayer. But the perspective driver requires more thinking as we have to compartmentalize, like divide into sections the components required to calculate the tax payable, i.e. gross income, exemptions and deductions, etc. And thankfully, in this case, like the perspective driver is closely linked to the application of the framework. So there will be no issues there. Now, getting straight into it, the first component which I want to talk about is gross income. So we include amounts into gross income component according to the gross income definition. But remember that there are additional paragraphs under the gross income definition that specifically include amounts in gross income, whether they are capital in nature or not. I.e., these amounts such as amounts received as a result of employment and fringe benefits. So let me just clarify now. When it comes to employment, now I know it seems, I don't know if you had this, it seems like it's revenue in nature, but now it's not. It's actually deemed to be capital in nature in terms of SARS. That's why we have a special inclusion for it. Otherwise, it would have been included in terms of the gross income definition. So just know that these amounts received as a result of employment are deemed to be capital in nature in terms of SARS and its legislation. So let's continue. So I went ahead and got straight to the point. I want to look at the specifics regarding the gross income component that might be tricky, but if you understand it, it becomes much more simple. So in terms of free residential accommodation provided by the employer, you have to be able to distinguish between the amounts like in cash received by the employer and fringe benefits received from the employer, as fringe benefits are amounts other than cash given to the employee. So you'd have to distinguish between the two because they are both included with different paragraphs under the gross income definition. So amounts in cash received from employer are included in terms of a separate paragraph, and fringe benefits are also included, but also in terms of a separate paragraph. That's what you must know. So in terms of free residential accommodation, when we get to it now, when it comes to calculating the benefit received, as it is a fringe benefit, it is not cash. You'll have your rental value minus your rental consideration if the employee has paid valid rental consideration. If they have not, there'll be no deduction of rental consideration. So rental value is if the employer owns the property, you simply apply the formula. But If the employer rents or leases the property, the value is the law of the amount paid by the employer or the amount per the formula. Now let's head to the formula. The formula is A minus B in brackets times C over 100 and times D over 12. So A represents the remuneration proxy. B is the abatement of 87,300 rand, but you must know that it will be reduced to zero if the employee has a controlling interest in the company, owns more than 50%. I don't know if that's within your scope, but at least you know it. Then C, yeah, there are three considerations for C, hence C.1 to 0.3. The first consideration, C will be 19 if the house is at least 4 rooms, is furnished, and the employer pays electricity. Yeah? And C.2, C will be 18 if the house is at least 4 rooms and is unfurnished with electricity or is furnished without electricity being paid by the employer. And then C.3, which is 17, where C is 17, this will come into being or happen when the house consists of less than any of the above requirements, i.e., if it is less than 4 rooms, or if it is both unfurnished and the employer also does not pay for electricity. I hope that's clear. Then these remember are the specifics regarding the gross income component. So I think maybe you might have a little trouble, but you won't, since I'm explaining this, it will be simpler hereafter. So in terms of the holiday accommodation, now this one is a more simpler calculation. It is also a fringe benefit. It is also a fringe benefit when the employer gives you this holiday accommodation, but the calculation is much more simpler than the free residential accommodation. So the benefit received, the formula here is the same. It will be rental value minus rental consideration, and the rental value will be, it depends also in this case. If the employer owns a property, it will be the market related rates per day. And if the employer leases the property, it will be the cost borne or taken up by the employer. Now, moving on to local dividends, you should remember that dividends have dividend withholding tax. So because of this, we'll have to include the gross amount of the dividend in the beneficial owner's gross income. The simple calculation for this is dividend received divided by 80%. This is represented is easily represented, or you can remember this by just saying or knowing this saying, it is what we have, the dividends received, over what we want, which is 80%. This is because dividends withholding tax, as you know, is 20% of the dividend, which is withheld by the company issuing the dividend. So we are done on local dividends. So let's head to rental income. Okay. So rental income, they can try to be tricky with rental income, but you must just in terms of income from other sources other than employment, you must just be sure with the wording in the scenario, because they can try to trick you and I don't know, use words such as investment property, and you might assume that the property is for investment purposes and hence it is capital in nature, but no, you'll be wrong in this case because you have not looked at the substance of that investment property. So in terms of rental income, although it is stated that income is from investment property, I said she here, but it's any person, a person, a person who has investment property now and earns rental income is considered to be running a trade if they earn rental income. You see, so it will, as a result, be for trading purposes and not for investment purposes. So what I want you to think about here is that this investment property will only be like capital in nature if it didn't earn like rental income, and it was just used to accumulate value over the years. As you know, property increases in value over the years. If it was just used for capital appreciation, then it would be investment property. It would be for investment purposes, I mean, and as a result, it would be capital in nature. But since the person could be earning rental income from the property, it is regarded as the person is regarded as carrying on a trade, and as a result, it will be revenue in nature, as the person in substance is regarded as carrying on a trade with the investment property. So the key thing here is the rental income. So if they receive the rental income, you know that it's for trade purposes. But if they just hold it for capital appreciation in terms of the value of the property, you know that it's capital in nature. and as a result, it won't be included in that gross income definition unless there's a specific paragraph under the definition that specifically includes it. But I spoke about that on top, where fringe benefits and amounts received by employers, received from employers, are included as per the paragraph. So let's move on. Moving on to our exemptions. Just note that I'm going through the components I was talking about. As I said, that the components, the perspective driver is closely linked to the framework. So me just going through the components is actually the whole framework. So these whole slides are the actual framework to calculating tax payable. But you'll see that when you get to the end. So when it comes to exemptions, these exemptions are enforced by Section 10 of the Income Tax Act. So you should know that your dividend exemptions in terms of Section 10(1)(k) and interest exemptions in terms of 10(1)(i), you should know them very well. So the dividends are fully exempt for all persons unless they are a person. Then in this case, you'll apply the 25 or 45 apportionment, and that is in terms of an individual. Since you are doing individuals, companies have a different apportionment for that in terms of foreign dividends received. But since we're dealing with individual, if it was foreign, we'd apportion it according to this fraction 25 or 45. But if it is a local dividend, the full dividend is exempt. So in terms of the individual, so the interest exemption name is only for natural persons and is limited to 23,800 if the natural person is under 65 years of age, and 34,500 if the natural person is at least 65 years of age. Hope that makes sense, but I'm sure it does. So moving on to the other component, deductions. So any expenditure incurred in the production of income will be allowed as a deduction in terms of Section 11A. This is where you have to be very careful and know your staff terms and differences between what is capital in nature and revenue in nature, but I was kind enough to break it down simply. So the key note here is that expenditure incurred in the production of income is revenue in nature, but expenditure incurred to create or improve a capital structure is capital in nature, i.e., this is the expenditure not incurred in the production of income if it is incurred to create or improve a capital structure. So in more simple terms, expenditure incurred to create or improve a capital structure is capital in nature, and expenditure incurred to work the capital structure is revenue in nature, i.e., it is incurred in the production of income. But you will see most of this application when I do the question with you. So moving on. Assessed loss. So they might give you an assessed loss, and you know that an assessed loss can be ring-fenced. Ring-fenced means carrying over to the next year, you see. So when an assessed loss is ring-fenced to the next year, you can actually deduct it from your taxable income after your deductions. So you see, like, the perspective driver here is really important in terms of the compartmentalization. Once you know your compartments really well for taxable income or tax payable, you won't really struggle that much. You just have to know the final details in terms of the specific applications of the legislation. But I'm sure they gave you that in your notes or slides or guide somewhere. But thankfully, I gave you I gave you everything of what you should consider. If there are things that I didn't consider, you'll tell me at the end of this session. So the assessed loss, after your deductions, you then proceed to deduct your assessed loss from the taxable income at that point. It's taxable income at that point. Me, I don't really use the framework of subtotals. I really like to understand this from my own point of view, but you might understand it as a subtotal at that point. But for me, it's just a taxable income at that point. It's simpler to understand, you see. And then we're going to the travel allowances. Before anything else, you must have an accurate logbook of the kilometers traveled before you consider anything else. You see what I mean? The formula for the portion of the travel allowance to be included in your taxable income is travel allowance, the travel allowance received throughout the year minus deemed or actual business costs. So let's look at these deemed and actual business costs. Now, there are two ways to calculate the business cost to be deducted, which are the deemed method and the actual method. When both are calculated, you'll choose the one that provides the best benefit for the taxpayer, i.e., you'll include the lowest amount of travel allowance to be included in taxable income between the two methods. I hope that makes sense. Now, with the focus being on deemed business costs, deemed, you know that you are focusing on deemed rates, but let me just guide you through the appropriate structure of calculating the deemed business costs. So the essence of this method is that we used deemed rates to calculate deemed costs. Yeah? Those rates will be provided in the table in the test. So the deemed rates are based on the cost of the taxpayers. Remember this, please, of the taxpayer's vehicle, including VAT. Always remember this. Yeah? Then the deemed rates to be selected are fixed cost per kilometer, fuel cost, or maintenance cost, but it is very visual and apparent on your table, which will be given to you in the test. So you don't really have to stress about memorizing these components. You'll see them on the table. You'll see them on the table, yeah. And then you'll proceed to aggregate these rates into one rate. Yeah? That rate will be multiplied by the actual business kilometers traveled as per the logbook. Then you'll get your deemed business costs. I think now you know what to do with this, because I don't like to repeat something I said. So after you have gotten your deemed business costs, what you'll do is you'll apply it to the formula above. Travel allowance received minus the deemed or actual business cost. So the only issue here and there for travel allowances is between the deemed and actual business cost. Once you know how to calculate that very well, you'll be fine. Yeah, and very you'll be fine as I'm showing you now with this clear description. So let's move on to the actual business cost. Now, I want you to think and look at the similarities in how these things are calculated. But I also hinted at these similarities within these sentences that describe the different costs deemed or business costs. So or points that describe the different costs deemed or actual business costs. So for actual business costs, there must be accurate records of the expenses incurred by the taxpayer before you consider anything else. This is very important for actual, because like they should be records, yeah, because these are actual expenses. If there aren't records, then you won't consider those expenses, yeah, so it's very important that there are records that are detailed, accurate records that detail the expenses that were incurred. Otherwise, you will not consider them. Now, the actual business cost will be wear and tear over 7 years, but limited to a cost of 665,000 rand, and other actual expenditure incurred by the taxpayer. Yeah, but it's simply this. I just broke it down and made it simple for you. It's simply this. I just wanted you to note that you mustn't forget this wear and tear. Well, the other actual expenditure, as long as it has like a record, you'll include it. You'll include it um uh in your calculation of actual business costs. And the wear and tear, it is like an actual business cost, because wear and tear is based like on the value of the vehicle. Yeah, well, so if the vehicle is being used and its value is decreasing as a result of the vehicle being used, that means that it is actually in substance an actual cost for the taxpayer as a result, because it is their vehicle. In this case, but I remember travel allowance is not a fringe benefit. So in this case, travel allowance was given to the taxpayer employee, but he owns the vehicle. So the costs paid by him do in fact include wear and tear, as his vehicle is losing value, as he's performing these business functions or traveling over these kilometers that consist of business functions or functions that are required by the business. So take note of the substance of the expenditure now, i.e., this what I mean is that is a description of the expenditure given in substance a maintenance cost. So what I mean is that they can just give you a different description of a cost, yeah, such as the cost on on tires, yeah. But if you have a cost of tires, you should know that you replacing the tires like it's actually maintenance, yeah. I don't know, an engine check, you doing that engine check is actually maintenance for that car. So you must just look at the substance of that in this case. Now, these actual business costs will be aggregated like the rates above. Remember, I told you about the similarities between the two. Just knowing the similarities between the two can help you remember it easier. And then you'll multiply the total expenditure, which is the actual business cost, by the business kilometers divided by the total kilometers. And then this will give you your actual business cost. And what do you do with this actual business cost? Yes, you are right. You are going to include it in your formula as prescribed or where appropriate. So you'll include it as the actual business cost. You should deduct the business cost from the travel allowance received. And after completing both of these costs, you'll have two two portions of travel allowance which you will include, and as a result, you'll choose the one that provides the best benefit for the taxpayer. But don't worry, that will be illustrated when you do the question. So this thing will be illustrated. Yeah. So in terms of the taxable capital gain, you should be careful of the wording used in the scenario. If they state that there was a capital gain, you should know that the taxable capital gain has not been calculated, and therefore you should have to calculate it. And remember that we are dealing with individuals, so you should apply the respective calculations now or considerations that you should consider when it is an individual when you're calculating the taxable capital gain. So what do you consider? You consider that 40,000 annual exclusion, and you also consider the 40% inclusion rate. Yeah. Now, moving on to retirement fund contributions. So contributions made to retirement funds are allowed as a deduction in terms of Section 11F. Note that contributions made by both the employer and the employee are allowed as a deduction, yeah? But they are limited to 350,000 Rand or 27.5% of the higher of remuneration from the employer, including the travel allowance at 80%, taxable income, including the or taxable income including the taxable capital gain. You see this when I do the question, you'll be more clear. Or taxable income before the inclusion of the taxable capital gain. So these two are one or requirement. There are actually three requirements, but these two are one or requirement, and there's this last one. This is the third requirement. You see what I mean? But you'll see the application of this when I do the question more clearly. Then moving on to donations deductions in terms of section 16A, 18A, you know that that donation will be allowed as a deduction if and only if there was the taxpayer was granted a section 18A certificate. If there was no section 18A certificate, that donation will not be allowed as a deduction. But you have to remember that or know that this donation deduction section 18A now will also be limited because SARS doesn't just SARS is ruthless. It doesn't just give away deductions like that. So this deduction will also be limited to the 10% of taxable income before the donations tax deduction. Hope is clear. Now, moving on to the tax payable. After taxable income has been calculated, you will then proceed to calculate the tax payable using the relevant tax tables. And I assume that this will obviously be given to you in the test. So yeah, that will be an easy calculation, which you only have to worry about. Then in terms of your primary rebates, now after you've calculated this simple tax payable calculation, you'll have your primary rebates. Now your primary rebates, I think you know them and I've taught you them. Now, let me see. Sorry, not just primary rebates. I meant like rebates. But I wrote primary rebates there. Sorry for that. But I meant like rebates. So for your rebates, you'll proceed to apply the primary, secondary, and tertiary rebates. Sorry for this. This is also like a mistake. Here it should be tertiary rebates. So you then proceed to apply the primary, secondary, and tertiary rebates if they are applicable. Yeah. So just know that these rebates apply in aggregation. So if both the primary and secondary rebates apply, you will apply both to your tax payable. So i.e., if you are above 65 years old, you'll get the primary and secondary rebate. And if you're above 75, I think you'll get the primary, secondary, and tertiary rebate. That's what I mean by that the applied in aggregation. Now, we'll move on to our medical rebates. You must know that for medical rebates to apply, the payments must be made to a registered medical aid scheme before you consider anything else. The payments must be made by the person/taxpayer on his or her own behalf or for the benefit of others that are dependent to the person or taxpayer. So what I mean is that the taxpayer can also not benefit from the medical aid scheme. Yeah? But as long as he has dependents that are within that scheme, he will apply the medical rebate will apply to him as he has paid for the benefits of those dependents. Now, these rebates apply as follows. Now, there will be 382 Rand for the person or taxpayer if they are alone, 664 Rand for the person or taxpayer and one dependent, 664 and in terms of two dependents, remember this is where the taxpayer does not benefit, is just paying these medical aid fees for the benefit of others which are dependents. They must be dependents. So in terms of okay, after that, 224 rand in terms of the of benefits to each additional dependent will be applied as a rebate. So let me just break this down. So if your medical aid scheme has three beneficiaries within it, or four, the first two will qualify for a rebate at 332 rand each. You see, then the additional two, after considering the first two, will apply the rebate will apply at 224 rand for those dependents. Yeah, and I hope you know what a dependent is. But simply put, a dependent like can be that person's spouse, or that person's children, or the children of that person's spouse. So I think that scope is all right for you, because there's a higher scope, but that scope is all right for you in terms of this context here in Bcom that year. I think that scope is all right for you. Just need to know that dependents would be the spouse, um, or the children of that person or taxpayer paying the medical aid scheme, or the children of that person's spouse. Those will be the dependents. And I hope, and also note that these rates are applied per month. Yeah. So I hope you understand how these rates are applied. 224 rand will be for each additional dependent after two beneficiaries have applied the 332 rand rebate. Then the rest will be at 224 rand. That makes sense, and I'm sure it does. So when it comes to medical rebates in terms of section 6B, this is what you have to understand. The taxpayers is grouped into three categories. So there are persons who are at least 65 years of age for I, persons with disability factor for II, then all the remaining taxpayers for category 3. You must note that the first two categories are calculating the same way, but the last category isn't. So I'll get to that on the other slides. You'll see what I mean by that. Then these are the two amounts that are considered for this section B rebate. So you'll consider the excess medical fee contributions there, and the excess medical fee contributions are the excess of the total medical fee contributions there, including contributions made by the employer. This will be made more clear when I do the question. Now, you also have to consider qualifying expenditure. So you'll aggregate these two for your medical rebate in terms of section 6B. But I'll further show you the detailed calculation on the next slide. So when it comes to the qualifying expenditure paid by the person or taxpayer, it can be in respect of that person or taxpayer, or a dependent of that person or taxpayer. So you should be very familiar with what a dependent is and who a dependent is. And I hope I explained it well to you what a dependent is. So moving on now. Now we're at the medical rebates, the section 6B calculations. Now the rebate for I and II will be qualifying expenditure plus excess medical fee contributions times 33.3%. You see, this is like more beneficial, but okay, let me just continue. I'll show you how it's more beneficial. Then the rebate for III will be qualifying expenditure plus excess medical fees contributions times 25%, less 7.5% of the taxpayer's taxable income. I think it is self-evident, it is obvious why. The rebate in terms of the first two categories, these two categories, is way better than the rebate in terms of the last category. As you can see, in terms of the last category, it's at a lower percentage rate, 25%, and you even deduct it by 7.5% of the taxpayer's taxable income. So it is not as beneficial as category I and II. And be vigilant of that, be aware of that, pay attention to that. So let's move on. In terms of the other taxes, which is the last slide in my set of slides. In terms of the other taxes, last but not least, employees tax deductions and all the provisional tax payments will be deducted from the tax payable. After which you'll get your final tax payable. So yeah, these slides were the complete framework and the explanation of of calculating tax payable. But now I'll apply it to a question so that you can see it clearly. Okay. Okay, what I'm gonna do now, I'm gonna do the okay. I did tax payable because it is most likely gonna be like a majority portion of your guys' tests. So if you just master that, let me see. I don't know this year how much this is gonna be out of, but for this test now, also when it comes to writing tests now, you must have exam technique as they say at the institutions, but I call it exam IQ. Like you're using your mind when you're performing your exam. Yeah, like simple things such as you can't like write or focus on what you didn't master. Like that would be like of detriment to you and you getting a greater mark. So what I mean is that let me just say, since like 51 marks of these 80 marks are mastered, that's like 100. That's like 64%. You know that you have mastered, né? Mastered completely. But I know that most of you will want to get like 100 or something. So so if you do get the opportunity to master those other sections, also do them. But what I'm saying is that focus on what you really mastered first and make sure that what you mastered first is a majority of what's going to be in the paper. That's an exam technique that has worked for me since my undergrad up until now in honors. And I'm very sure it will work for you. Now let's go to question one. Yeah, well. So Precious Glove is 46 years old. Okay, I always do this. We always pay attention to things that are significant. That age is very significant. Remember what I was doing in the slides, specifically the last section where we are talking about section 6B. We are talking about the guy's ages, the rebates. In fact, the age is important, like for a lot of aspects of the tax payable calculation. So Precious Glove is 46 years old, a resident of the Republic. She's the financial director of Alport Pty Ltd. So she's an employee of Alport Pty Ltd. Her husband Kagiso, to whom she is married by anti-nuptial contract. Also, don't just go over this. Anti-nuptial means that they are not married in community of property. What does this mean? It means that, remember, in terms of married persons in community of property, when it comes to passive income, then they both receive the income equally in terms of their taxable income. But in this case, since they're not married in community of property, they'll not receive passive income equally, and passive income that is due to Precious Ndlovu will fully accrue to Precious Ndlovu or be included in Precious Ndlovu's taxable income as they are married out of community of property. That is what is meant when they say that they are married by an anti-nuptial contract. So another thing about accounting, you should also pay attention to the English words that they use. So, cause like honestly, the most like the best way that they can like mislead you is using like words that you don't understand. They even do that like at an honors level. So just be sure that you understand what things mean in a scenario. Don't just go over things. So Kagiso was in a motor vehicle accident 4 years ago, and as a result is a paraplegic. So he's paralyzed from his waist down. What is this? Like, if you consider those section 6B rebates also. So they have two daughters, Tandolwe, who is 8 years old, and Sipesishle, 5 years old. These are what? These are dependents. So you must do this with the framework in your mind, identifying things so that when you answer, you're just gonna be fast with it. And it'll save a lot of time and get you all the marks that you want. So here it is now. They're giving you information that applies to a 2022 year of assessment. Now, here's another exam technique that I want you guys to use. I think it will be very beneficial to you guys and it will keep you like in track. So remember that the perspective driver, the compartmentalization. Let me check the chat. Yes, there will be a recording, so don't worry. Don't worry, Kanyisa. There will be a recording. This session will be recorded. So that's fine. So the following information applies to for the 2022 of year of assessment. So remember that perspective driver that I talked about in terms of compartmentalization. I think before you even like start reading these things, since you know what must happen, I think you've mastered this content after studying and you're an expert, you'll have to compartmentalize those different sections, as I said. It'll make your answering much more easier. So what are you gonna do? Let me do this. I'm gonna do it horizontally, but you can do it vertically, but vertically you must like count a lot of number of spaces so that like you don't like provide work that is unneat, so but I'm gonna do it horizontally, but you in your test you do it vertically. Just make sure you give the necessary spaces in between the compartments, yeah, so must be prudent in that case. So overestimate the amount that you wanna write. That will be like a good way of spacing. Overestimate what you wanna write. So what I wanna do here is gonna start with my gross income. Remember that I'm doing it horizontally, whereas you must do it vertically in the test. So have your cost income here, and you'll have your exempt income. That's too far. Yeah, then you'll have your exempt income. So that perspective driver of compartmentalization, like, it's very important here, and you'll guarantee your success. I'm sure of it. So then you'll have your debt deductions. And then you'll have your travel allowances. The others are like your taxable capital gains and your Section 11F deductions and your donations deductions that we'll consider later, because there are separate sections. Even in your framework, you'll see that there are separate sections and they are at the bottom level. So I'll consider those later level. So otherwise there would be taxable capital gain here and Section 11F deductions and your donations deductions here. But now let's just focus on these four. So in terms of cost income, okay, this is the exam technical IQ that I'm suggesting for you. So in terms of cost income, I should exit this. Let's go back to the question. Yeah. Oh, they're even on the top here, so it's easy to see them even here. So in terms of your cost income, I think you that she has a basic monthly salary of 85,000 rand. Yeah. So that is monthly, as you know, it is monthly. So you should know that you should consider it for the whole year. She works for the whole year of assessment, because this is for her 2022 year of assessment. They didn't talk anything about her getting fired or her stopping work. She was working the whole year. So what you're gonna do is that you'll take this 85,000 and multiply it by 12. So here you'll have your basic salary. Simply be 85,000. So what is 85,000 times 12? 120,000. So it is 20. Basic salary. So moving on now, she received uh, an annual bonus of 85,000 on 1st December 2021. Remember, remember that document, those slides that I was doing, they're very important, because everything I'm saying there, I'm applying. Like, I think, yeah, they're the crux of this. They're the most important thing here. So remember that I said that amounts received from employers are specifically included in cost income, as per the paragraphs under the cost income definition. So this bonus, it is an amount received from the employer as a result of your employment with him. So you will include this amount in your cost income. And remember, I said that amounts received from employer are deemed capital, so they're included in terms of the paragraphs under the gross income definition. I'm sure you know those paragraphs, or they've talked about them in your lectures. Now you will just include the full 85,000. Yes. Okay. You see that her employer contributes 60% of her medical aid scheme contributions, and she contributes the rest for the year of assessment. The social contributions to the medical scheme amounted to 73,500 rand. It needs to be noted that she paid qualifying expenses amounting to 94,910 rand, which are not covered by her medical scheme. So there's a lot of information here. You should just pick what's relevant for now. So in terms of this information, they say that her employer contributes 60% of her medical scheme contributions. In substance, what is that? It is an amount received from the employer, no? And that amount received from the employer is going to medical aid contributions. Nonetheless, even if it's not received by the taxpayer, it's for the benefit of the taxpayer. So as a result of this amount being received from the employer in substance, it will be included in your gross income as per the paragraphs under the gross income definition. So what you'll do here is that we only include the medical aid contributions one, yeah, because the employee will pay her own medical aid using the money from the salary. Yeah, so contributions. And this is from the employer, yeah? You can just write yourself medical aid contributions. So these medical aid contributions from the employer will be 73,500 times, yeah, you're right, 60%. So 73,500 times 60 shift percent. What is that? That's 44,100. That's 44,100. This is just me. Yeah, so moving on. So yeah, you know that the amount received from the employer is the 60%. The medical fees that you pay out of your own money, so you pay using the basic salary, which you receive from the employee and you're already considered here. So, or you can pay using other forms of money, but you're just paying it yourself. So it needs to be noted that you pay a qualifying expenditure that will be used later in section 6B. As of now, that is not our focus. So let's move on. Now Precious and her family live in a house owned by Alroad. She has been living in it for the past 5 years. The house has 3 bedrooms and is provided unfurnished to Precious. She pays her own electricity. Her remuneration proxy for the 2021 year of assessment was what? 990,000. So you know this is what is a fringe benefit. You didn't receive cash. Sorry about that. You know that this is a fringe benefit. So what is it? What is this fringe benefit? It's residential accommodation. And so for you guys, you don't need to specifically know those standards straight, but you must just know the implication of that scope. So don't be pressed on the standards themselves. Know the implication very well. So for residential accommodation, you want to use that formula that you used, yeah? So it would be 990,000 minus 87,300. Yeah, plus 87,300. Now, remember I talked about the different fees, yeah, the different fees. Yeah? And I talked about how they apply. You know, like the first one, everything is paid for. The second one, it is for these 4 rooms, and it's either it is unfurnished and electricity is paid for, or it is furnished and electricity is not paid for. That's the second one. But in this case, let us see. The house has 3 bedrooms, and I said that if one of the component is not met, no? I said that if one of the component is not met, you will have to use section C17. So one of the components that were not met were the 4 bedrooms. So just because of that 4 bedrooms was not met, you'll have to apply section C. So you have to apply C.3 as I show you on the slides, yeah, which are which is 17, because the 3 bedrooms are less than 4. Let me just show you. I want to show you one so that you know what I'm talking about. Just that I know it well. So I want you to show you. What is this? C.3, remember? If the house consists of less than any of the above requirements, less than 4 rooms, or if it is both unfurnished, and the employer also doesn't pay for electricity. But we just stuck here. So less than 4 rooms or 3 rooms, so you lose 17. So let's continue our calculation. Yeah. So you simply multiply it by 17 shift percent, it's over 100, times what? 12 over 12. This is what, because it wasn't used the whole year. She was employed the whole year. And what will the amount be? So 990,000 minus 87,300 equals 9,700 times 17 shift percent, and that is just times 1. So you don't need to consider, it's just times 1, 12 over 12. So the final answer will be equals to 153,459. And this will be included in your gross income. Now let's move on. And Alroad owns a holiday flat, 4 bedrooms, a lounge, dining room, kitchen, and 2 bedrooms. You see, they try to trick you sometimes. Like, you don't really know, you don't really need to know the number of rooms here, because it's a holiday flat in substance, or as defined. It is not residential accommodation is defined. This is for holiday. Just to give you a clear distinction, residential accommodation is where you are ordinarily resident. So it's where you are staying most of the time in the year, or where you permanently stay. Holiday flat, you can see, is not permanent stay, it's just for holidays. So you'll apply what I said in the slides. So what do you do? I don't want to run out of space here. So what you do is you'll have your holiday flat. Your holiday flat, yeah? Then with this holiday flat, what you'll do is that, remember, I said there are 2 conditions. It's either the employer there are 2 conditions that depend on whether the employer owns the building, or when the employer rents out the building. So let's just check here. Arnold owns the holiday flat kitchen in Player 2. The staff are intended to use on vacation. Yeah, well, so they own it. So that means that the rate per day will be based on the market related prices per day. So Precious and the family spent 14 days during the children's school holidays there, and Alro did not charge them anything. So there's nothing to be deducted. Yeah, well, as here above, they didn't say that she paid, so it's the same here. She didn't pay for this holiday flat accommodation. So they continue to say that when staff members do not occupy the holiday flat, it is rented out at 600 rand per day. So it is simple. We'll simply take our 600 rand and we'll multiply it by our 14 to get the French benefit as a result of this holiday house given to us by the employer. But the thing is, we didn't pay anything, so it'll just be that. And remember, I said this like it's a much more simple calculation as to the above one, the residential accommodation, and you can see why. Times 600. What is that? It's 8,400. 8,400. see, much more simpler calculation based on days, and that's all compared to this. But even this is simple. It's just that you have to understand what to do. So let's move on. Furthermore, she's a member of the. Let me just show this clearly. Furthermore, she is a member of Alrod's um, pension fund, and she contributes 8% of her basic salary to the fund. She contributes herself. And Alrod matches her contribution by contributing an equivalent 8% of her basic salary to the pension fund. So I think you'll see the person here. The principle that will apply here is the same as the principle applied for the medical aid contribution, because this is the amount received from the employer as a result of employment. So it is simple. It's separate from the fringe benefit. It is not a fringe benefit. This is like cash received from the employer, but it was given to the pension fund for the employee's benefit. So let's calculate this 8% that should be included. So it would be pension fund contribution. Yeah. Okay, now I don't need to write employer. I think you know that it's from the employer. Let me just save space here. Contribution, you know that. So what would it be? It will be our 8%, and Aaron matches her contribution by contributing an equivalent 8% of her basic salary to the pension fund. So it will simply be 8% of um this person, this taxpayer's basic salary, Precious's basic salary. So it will simply be 8 shift percent times 1020123 shift bracket. Then this would be our answer. It will simply be 81,600 to be included in your gross income. Okay, let's move on. She also contributes 10,400 per month to a retirement annuity fund. Okay. She contributed this her by herself, so this will have no effect on your gross income. And it only has an effect if the employer contributes, because that's seen as cost income for the taxpayer. Now let's move on. Okay. All right. Now with this information, are there any exemptions here? No, there aren't any exemptions. No, there aren't. So let's move on to the travel allowance. I don't like this spacing. Sorry, it's just that I can see that the spacing would be a problem. So let me just space it a little further apart. Everything I'm saying here is what I did in my slides, what I went through my slides. So let's continue with our travel allowance. So in terms of the travel allowance, like what are they saying? What are they saying in terms of travel allowance? Let's see. So Precious received a monthly travel allowance of 15,000 rand. She bought a car 3 years ago for 260,000 rand, inclusive of that. Remember what I said about that? She has kept an accurate logbook, yes, and can prove that of the 47,072 kilometers traveled during the 2022 year of assessment, 32,485 kilometers were for business purposes. Okay. Her accurate expense records, what is this going to be used for? Is you're right, it's going to be used for the actual expenditure. So the actual expenditure method. So now you know that there will be a deemed expenditure method and then actual expenditure method. And you'll choose the one that promotes the most benefit for the taxpayer between the two, as I said on the slides. So Her accurate expense of course indicated she spent 21,864 rand on fuel, 500 rand on license fees, and 2,800 rand on insurance, and 8,530 rand on tires throughout the year. Remember what I talked about in terms of the substance of this expenditure. As the car is still under maintenance plans, no further maintenance costs were incurred. Now, let's start with our deemed method. Yeah. So at first, you will include the terminal allowance received for the year. Yeah. Received for the year. Let me just do that. The R is for receive, no? Just that I see I have no space here. The R is for so what will be our terminal allowance received? It will be our one what is it? 15,000, right? Yes, 15 yeah, 15,000. It's 15,000 times 12 shift bracket, and it'll give us an amount of what? 80,000. It'll give us an amount of 180,000. So this amount now, just keep it here on the side. It's not like the final amount. It's not included in. It is not yet included in taxable income because we should still have to compare between the actual method and the deemed method. So if this 180,000, just keep it there for now. So moving on, we now have to get our deemed cost. Remember the formula is terminal allowance received minus deemed or actual business cost. But for now, we're dealing with our deemed cost. And how do we calculate our deemed cost? It is based on the cost of the vehicle for the employee, which is 360,000 rand, including VAT. So it is based on the 360,000 rand. It is based on it. This is not I'm just saying it's based on this. And then they'll give you the table. I don't know if you have the table with you, but you'll have to check like the rates that apply in terms of this value. So where the value of the vehicle is above 285,000, but does not exceed 380,000, the fixed cost element will be 94,871. The fixed cost element will be used to calculate the fixed cost per kilometer, as I referred to in the slides, or spoke about it in the slides. So since the 360,000 including VAT is above 285,000 but below 390,000 rand, you have 94,871 as your fixed cost. So this is for fixed cost, equals 94,871. Now remember that it is fixed cost per kilometers, but which kilometers do you use? Yes, you are right. You use total kilometers because we are still going to apportion it according to the business kilometers. You will still want to multiply it to the business kilometers traveled, as according to what I said in the slides. So 94,871 divided by 47,072. Yeah, that will give us an amount of 2.015. Now, this 2.015, I know this amount, the fixed cost element, it's in rands in our on the table, but what? Sorry, guys, are you still in there? Something happened here by my side. So can you still hear me? Please, like, reply to me because I don't know what happened. Something happened. Hello, guys. Okay, it's fine. Okay, let me just continue now. The thing is, it deleted all. I don't know why it deleted all of that work, but Yeah, it's fine. I'll just continue where I left off. So it's fine. Uh, yeah. So let me just continue where I left off. So where was I? Where was I? Oh, I was at the travel allowance, nah. So let me do that. Let me do the travel allowance thing. So was it travel allowance? Hey, what's going on? Mm. It's just that I can't use my tools anymore. I don't know what happened here. Yes. You know what, guys? Let me just set up a new meeting, and I'll continue where I left off because my tools are not visible anymore now. Wait. No, they're back. It's fine. It's fine. It's fine. Just that something happened for no reason. Now everything is fine now. I'll just continue. So yeah, let me continue with the travel allowances. So let me annotate. So I'll share my travel allowances. So when it comes to our travel allowances, where were we at? We at eight. Yeah, technology, yeah. So guys, like there's something wrong with Zoom. Like every time I try to do something, it's going back for no reason. Uh, I don't know what's happening today, but yeah, still not done this. So we're doing travel allowance. So yeah, when it comes to the travel allowance now, yeah, we just calculated that the travel allowance received. I'm not gonna do the calculation again.